You're watching the latest news from financialmirror.tv. After a week of turmoil, global markets experienced mixed fortunes on Monday following Washington's proposed $700 billion plan to solve the world financial crisis by rescuing banks from billions of dollars in risky mortgage debt. European markets, after edging higher in early trading, had fallen by Monday afternoon. Britain's FTSE 100, Germany's DAX and France's CAC 40 lost under 1% each. However, Russian stocks rose again following Friday's big gains, with the MICEX climbing more than 2% and the dollar-denominated RTS adding 1.6%. Analysts at Cantor Fitzgerald said there was massive reaction on Friday to a likely bailout plan, while on Monday there was an element of profit-taking and some worries as oil prices moved higher again. There was better news in Asia as Japan's Nikkei 225 index and Hong Kong's Hang Seng index rose by about 1.5%. In China, the Shanghai Composite Index soared nearly 8% on hopes of a turnaround after the government announced steps to stabilise the country's beaten-down shares. Markets in Australia and Taiwan also advanced strongly after their regulators issued curbs on short selling, following similar moves in the US and Britain. Goldman Sachs and Morgan Stanley sought shelter with the Federal Reserve to survive a financial storm that destroyed their rivals, as Wall Street braced for a week of political wrangling over a proposed $700 billion bailout for troubled banks. Morgan Stanley went a step further and struck a deal with Japan's largest bank, Mitsubishi UFJ Financial Group, which agreed to buy up to a 20% stake, sending Morgan Stanley shares up 12%. The Fed's agreement to convert the once high-flying investment banks into more conventional depository institutions was Washington's latest effort to restore calm to chaotic markets. It followed frantic talks between the Bush administration and Congress to prevent the crisis from pushing the economy into severe recession. The rebound came as governments worldwide unveiled a series of steps to free credit markets from a deep freeze and prevent a run on assets from stocks to mutual funds. By agreeing to much tighter Fed regulation as bank holding companies Goldman Sachs and Morgan Stanley moved to avoid the fate of rivals that either collapsed or were taken over in the worst financial crisis to sweep Wall Street since the Great Depression. Japan's Nomura Holdings has reached a deal to buy the Asian operations of Lehman Brothers, outbidding other banks seeking to scoop up Lehman's Asia Group on the cheap. Lehman Brothers last week filed for bankruptcy protection after collapsing from exposure to risky subprime mortgage securities. Barclays struck a $1.75 billion deal to rescue Lehman's core US business and signaled it might do the same for other units. Reuters reported that Standard Chartered was also interested in Lehman's Asian assets. Barclays was interested in parts of Lehman's European equities and equity capital markets businesses. Lehman, once the fourth biggest US investment bank, filed the largest ever US bankruptcy case after collapsing from exposure to risky securities backed by subprime mortgages. Japanese Finance Minister Bunmei Ibuki said that he saw no need for Japan to set up a US-style rescue plan to help its own banks offload bad assets, but welcomed a recent series of steps by the United States on financial markets. He also said that Tokyo is unlikely to take new steps to restrict short selling of stocks, as its current framework has already been tight enough. Confidence also returned to Japan as Taro Aso, the country's next prime minister, an advocate of spending and tax cuts to boost the economy, is expected to form a cabinet when he formally assumes the post on Wednesday, as he confronts sensitive ties with neighbouring China, a feisty opposition and an economy heading towards recession. Britain's Chancellor of the Exchequer urged the government on Monday to stop bickering and unite behind Prime Minister Gordon Brown to fight a financial crisis. Brown faces calls to quit from some members of his ruling Labour Party. That's meeting in Manchester, trailing the opposition Conservatives in opinion polls, but says he is the best person to guide Britain through its economic problems. Inflation and unemployment are high in Britain, the housing market's in decline, and the economy is on the brink of recession. Voters appear fed up with Labour after 11 years in power. The economy, once the jewel in the party's crown, has been hit by the global credit crunch and is on the brink of recession for the first time since 1992. The cost of borrowing in dollars overnight fell after the US government widened the scope of its $700 billion bank rescue plan in an attempt to shore up the financial system. The London Interbank Offered Rate, or LIBOR, for such loans slid to 2.97% today, according to the British Bankers Association. That's 97 basis points higher than the Federal Reserve's target rate, compared with an average 10 basis points during the past 7 years. The cost of borrowing in euros for 1 week rose on Monday to the highest level since May 2001, according to the European Banking Federation. The Euro interbank offered rate, or Euribor, jumped to 4.65%. The 3-month rate climbed to just over 5%, the highest level since November 2000. Microsoft, seeking to revive its share price after a 29% slump this year, plans to buy back as much as $40 billion in stock, raise its dividend and issue its first commercial paper. Microsoft rose 4.7% after adding a $2 billion commercial paper program and saying it may ultimately sell as much as $6 billion in debt, prompting Standard & Poor's to give its highest possible credit rating to Microsoft. The world's biggest software maker is returning money to shareholders after its failed $47.5 billion bid for Yahoo drove the stock down. Thank you for watching FinancialMirror.tv.